Happy Friday, everyone. January 21st, 2011. Very interesting day today, very interesting close to the week. We're seeing a very hefty sell-off in risk and equity markets. If I look at the NASDAQ here towards the close, we're about 20 minutes ahead of the close. It's off some 60 points from the highs. And normally in FX, we've been trained of late to think of risk sell-off being a dollar positive. We haven't seen that. If we look at the euro-dollar chart here in front of you, we're seeing quite a big rally today. But I would argue that it's not so much about dollar negativity, this chart, as it is about a very positive euro action in the euro. And if we look at other crosses like euro key, we're seeing a huge rise in recent days. That's over 1,000 pips from the lows below 170. We look at EuroCAD, similar, and even something like euro emerging markets, euro South African rand, huge rally. And so we've got the euro driven higher. Question being now, of course, what does it mean elsewhere in FX? And if we look here at an Aussie dollar chart, we see that the dollar versus the Aussie over the last couple of days is still quite a bit stronger. Aussie dollar lower here. It hasn't broken out of the range, but again, this is about euro positivity more than it is about dollar negativity. And a couple of drivers here, I think, if we're looking at what is causing the euro to be so strong. I'm sure the European officials would like to think it's the rhetoric coming out of Europe. Regardless of what it is, there are a couple of drivers here that I'd like to show you. And one of those is, well, in general, I will say this. I think the pain trade, this is the pain trade. Euro strength, everybody's been short the euro. This is probably one of the big commonsensical trades out there in macro land. EU's going down. We all have to be short the euro structurally. And look at the liquidity coming out of the Fed. In the U.S., we have to be long risk, long emerging markets. So again, the charts I just showed you showing the intense pain in these trades, in this consensus trade. And I think a lot of this squeeze we're seeing into today's close on a Friday being, again, a squeeze on some lazy positioning out there in the market on short euro positive risk positions getting squeezed the wrong way. So let's look at, if I can talk and think at the same time here, let's look at, for example, we're seeing some support, the dark blue line being euro dollar, the lighter line being the spread on Italian and Spanish 10-year debt versus German. We're seeing quite a big unwind there in terms of the bond spreads. Now we can argue that some of this may be due to ECB support and the buying of bonds and so on, but even in the CDS price, we're seeing this kind of action, very strong tightening in the spreads here. So that's been an important factor, as you can see, with the correlation, sometimes anyway, with that spread. Now, we highlighted this chart a couple of days ago on our FX tools, and this is a little bit less supportive of that, but still today we're seeing U.S. Spreads wider versus Germany, giving a little bit of support to the fact, or to the euro-dollar rally. If we look at another chart along these lines, and that would just simply be the interest rate spreads. We can see after Trichet's rather hawkish appearance at the last ECB meeting, we've seen the spreads go a lot wider for European 2-year rates, which includes sort of the furthest out, if you will, of central bank expectations relative to U.S. rates, and that supports the euro-dollar higher as well. Additionally, interesting on the CDS front, credit default swaps on sovereign debt. We take a Bloomberg, and again, all these charts I've been showing you that are not the Saxo Trader charts are made possible by Bloomberg, either this one directly in Bloomberg, the other one's Excel charts from Bloomberg data. Very interesting developments in the credit default swaps. We've had, I didn't show it here, but a lot of the PIGs, as we showed in the spreads on Italian and Spanish debt, the spreads have been coming in for some of the PIGs stuff, and the CDS price has been falling a lot for the PIGs countries, apparently in the hopes that we're going to be coming up in the coming weeks with some kind of solution to the euro sovereign debt crisis. But if we look at elsewhere, the United States, a huge acceleration here in the perceived risk. A lot of that, I think, justifiable in terms of the Obama package, extension of employment benefits, the lack of showing fiscal austerity, what have you. Germany, as you see, has been more stable, generally rising over the last several months, but more stable recently. UK, interestingly enough, falling, and that's a good driver of UK risk falling, US risk rising. That's been a big driver of the cable rally of late, and the reason we're trading just about 160 to close here in cable. The Japanese, very interesting. Their CDS price has been going very high of late. Justifiably, if interest rates go up, Japan's in trouble. Although we do see the last couple of days, we've seen the CDS prices coming off a bit. So these are the drivers here. What is the potential? Oh, we can look at a few charts here. If we look at euro-dollar, drew some Fibonacci lines in. The 618 is a classic. That would put us at 137.40 as a possible turnaround point in the future. For whatever reason, euro-dollar tends to like the 76.40 or the 764, if you will, Fibonacci retracement. That has to allow all the way to 139.46 according to these levels drawn on this chart, which aren't necessarily definitive because they've been eyeballed. But it gives you an idea of the potential if we're going to be looking for Fibonacci retracements there. And then if we head over to Aussie dollar, for example, again, the euro-dollar chart I think is more about euro than it is about the dollar. Dollar still relatively resilient. I'm a bit surprised not to see the Aussie lower with this week close today. I think perhaps there's a bit of focus on the tech sector and equity weakness. If it was broader based and the S&P as well, which is still slightly up versus yesterday on the S&P, then we might see the Aussie weaker. But we'll wait till Monday. Of course, the key here on this chart, 98, or slightly above 98, the low here. And again, there's a very nice Fibonacci retracement. This is just a classic use of the Fibonacci. We had it up into the 618 retracement, almost to the pip before the recent sell-off. So that's a key resistance next week, 10085, and even parity really on that chart. Finally, I think on the charts for next week, if we look at, I don't have time here, but on dollar Canada, we did see that this week. We did see this puncturing back above the parity level and above the old lines that were the old lows, some resistance. That weakened up the chart. The interesting thing being there, we found, and I put this out on Twitter. You can follow me at John J. Hardy on Twitter for these intraday notes on some tech levels. We hit the 618 Fibo off of that retracement. Very, very interesting move there. Also the 200-hour moving average coming in there, and that was interesting. We didn't quite get through this local resistance line at 99.50, which would have been a fuller reversal, if you will. The key parity level. We need to close above parity. If you look back at the daily here, we haven't done that on the dollar Canada chart. And of course, with dollar Canada, we have to look at oil prices. They've been weakening, softening up late. The retail sales data out today is very strong, but it's ancient data. It's from November, and it's really oil prices. And I think the overall moves and risk that are a bit more important here. Here, if we look at the Canadian dollar, now this is inverse, so this is CAD dollar in blue, and oil prices, WTI, crude in red. Spot the correlation if you can. I think it's pretty easy. So obviously, oil is going to be very important as an input on the trajectory of dollar Canada. So again, a very interesting close. I think a lot of this is a positioning squeeze. We do have some fundamental support for the euro rally in terms of softening attitude towards risk. Very uncertain if we look back at the weekly level where we are here with the euro dollar. It's kind of halfway between the old rally top and this recent sell-off low. But a huge recovery in some of the euro crosses, and you have to wonder if in crosses like Euro Kiwi, Euro Aussie, Euro CAD, if we've put in some kind of significant low. The squeeze here has been pretty persistent over a number of days, and I think this might be setting up some kind of broad-based euro strength. Even if that eventually, if we keep selling off in risk, I don't think euro dollar is going to survive in rally mode for long. I think the dollar will eventually would predominate if we do see a bigger adjustment in equity prices lower. That about does it for this week. Hope you enjoyed this first edition of our FX daily update. This has just been a weekly wrap-up, and check back here in the future. Again, for sort of intraday updates, follow me, John Hardy, on @JohnJHardy on Twitter. And I wish you all a wonderful weekend. We'll see you back on Monday. Over and out.